Welcome to vTalkInsight, Risk Sentiment Daily for April 21st, 2026. Energy disruption in the Middle East is colliding with strong earnings and an AI-powered equity rally, leaving risk sentiment resilient but increasingly fragile. Let's unpack what is driving risk appetite, what is weighing on it, and how that balance is shifting across assets. Across assets, today's risk tone looks resilient but fragile. Equities have only given back a small portion of recent gains, and volatility, while edging higher, remains below the kind of stress level seen in past geopolitical shocks. Credit spreads, especially in Europe, are still near multi-decade tights, suggesting markets continue to believe that growth and earnings can weather current headlines. At the same time, the macro backdrop is moving away from the old Goldilocks narrative. The effective closure of the Strait of Hormuz, the surge in physical crude prices, and mounting evidence of refinery and jet fuel bottlenecks all point to a more inflationary, volatile regime. Policy uncertainty around the Federal Reserve, including a noisy leadership transition and more hawkish commentary, adds another layer of risk to that mix. Positioning and flows still lean toward buying dips, and many investors are simultaneously hedging downside and keeping exposure to sharp rallies. Yet there is a clear disconnect between elevated economic and policy uncertainty and relatively contained index volatility, which implies some complacency about tail risks. The net result is a two-way environment where strong micro fundamentals keep risk assets supported, but the margin for error around geopolitics, energy, and policy has narrowed materially. Earnings strength and an AI-driven tech rally are still the primary pillars supporting equity risk appetite. U.S. corporate results are being revised higher, with expectations for a sixth consecutive quarter of double-digit earnings per share growth for the S&P 500. Technology, particularly semiconductors and the largest software and platform names, is providing the bulk of that growth. Latest reporting points to first quarter earnings tracking around the low teens in growth year-on-year, and roughly 85% of that uplift is coming from tech-related sectors. AI infrastructure demand is central here, driving a powerful rebound in software and chip stocks after a prolonged drawdown, and feeding into a broader risk-on tone in growth indices like the Nasdaq. Company-specific stories, from cloud providers to design software leaders, are reinforcing the narrative that AI capex remains in an early, multi-year upswing. This earnings power supports higher equity multiples and helps markets look through near-term macro noise. However, a large share of index-level earnings growth is concentrated in just a handful of companies, such as key memory and GPU manufacturers, which means the broader market is increasingly hostage to the fortunes of a small AI complex. If monetization of AI investment lags expectations, or if any of the leaders stumble on guidance, the same narrow leadership that lifted indices could amplify downside volatility. Market resilience, despite the Middle East shock, is the second key bullish driver. Even as tensions escalate and shipping through the Strait of Hormuz has largely ground to a halt, U.S. equities have stayed close to their recent highs, and the VIX index is still trading below 20. European equity and credit risk premia sit near 20-year lows, signaling that many investors continue to assume the conflict can be contained without derailing global growth. Recent pullbacks in risk assets have generally been shallow and treated as opportunities to re-enter favored themes. Volatility term structures have flattened after the rally, and downside hedges have become cheaper, allowing some investors to hold risk while selectively adding protection. There is also a strong belief, informed by past episodes, that geopolitical shocks are often digested quickly and that markets can go on to set new highs within weeks once the immediate uncertainty fades. That resilience is a double-edged sword. There is a growing disconnect between the level of economic policy uncertainty and relatively muted equity volatility, suggesting that the market is underpricing the probability of a more severe escalation or a prolonged disruption to energy flows. Any surprise on the geopolitical or inflation front could therefore trigger a sharper repricing than the day-to-day moves would currently imply. Defense and commodity-backed real assets are emerging as notable beneficiaries in this environment. The Bloomberg Commodity Index has climbed more than 20% over the past year and over a third in 2 years, reflecting persistent supply constraints and robust demand across energy and key metals. Elevated oil prices are supporting energy producers and commodity exporters, even as they pose challenges for import-dependent economies. On the fiscal side, U.S. defense spending is projected to rise toward $1.5 trillion for fiscal 2027, one of the largest expansions since World War II. Large defense primes are positioned to capture outsized benefits from major programs, while conflict-related damage of at least $60 billion in Gulf Cooperation Council infrastructure is expected to drive over $100 billion in rebuilding and defense investment over the coming years. This underpins a multi-year capital expenditure cycle across defense, logistics, and energy infrastructure. Strategic initiatives in rare earths and supply chain rewiring add to this real asset theme. Government-backed funding to accelerate domestic processing and long-term offtake agreements for key magnetic elements highlight efforts to secure critical inputs for the energy transition and advanced manufacturing. For portfolios, these trends point to a world where commodities, infrastructure, and defense exposure play a more central role in diversification as the floor and volatility of inflation drift higher. Set against those supports, the Middle East energy shock and inflation risk remain the dominant bearish force. The Strait of Hormuz is effectively closed, with both U.S. and Iranian forces enforcing blockades and commercial shipping largely halted. Crude exports through the corridor have nearly stopped, with only a couple of cargoes getting through in the past week, threatening supply to key Asian and European buyers. Oil prices have already jumped by more than 5%, with key benchmarks approaching the $90 to $95 range, and physical barrels changing hands at premia well above quoted futures. Banks and commodity strategists warn that if disruptions persist, the market could face a shortfall of 2 to 3 million barrels per day into year-end, with some refineries and pipelines in the region severely damaged and over 80 facilities affected. Jet fuel inventories in Europe are measured in just a few weeks of cover, raising the risk of route cuts and higher travel costs. These dynamics are inherently inflationary. The conflict is expected to add upward pressure on prices, keep interest rates elevated for longer, and hurt energy-intensive sectors such as airlines and agriculture, even as it benefits military contractors and some commodity exporters. For emerging and lower-income economies, especially in Asia and Africa, higher energy and food costs, along with weaker currencies, increase the risk of a broader economic shock that could eventually feed back into developed market demand and earnings. Another important headwind is valuation concentration and narrow market leadership. A significant share of S&P 500 earnings growth is coming from just 2 companies, while 7 mega-cap names account for roughly half of the index's performance. This leaves broad equity benchmarks heavily dependent on the fortunes of a small group of AI and tech champions. Enthusiasm around AI and data center demand has driven a substantial re-rating in related stocks. Yet only a limited number of firms can currently demonstrate clear returns on their AI capex, and some analysts argue that the market has priced in very optimistic growth trajectories and monetization timelines. That raises the risk of disappointment if earnings or guidance fail to keep pace with expectations. With valuations elevated and breadth thin, single stock reactions to any negative surprise can be extreme. If growth momentum softens, or if energy-induced inflation pressures erode margins, momentum-driven flows and buy the dip behavior could reverse quickly, amplifying volatility on the downside. For allocators, this backdrop increases the importance of understanding where index-level exposure actually resides, rather than assuming broad, diversified earnings support. Finally, latent financial and cyber tail risks are building beneath the surface. In private credit, loan marks have slipped below par, prompting some retail-oriented vehicles to face redemption requests at 100 cents on the dollar even as market pricing implies losses. Withdrawal limits are being tested and more gating is possible, although leverage levels and risk recognition mean this is not viewed as a systemic banking threat for now. The private equity secondary market has grown into a mainstream portfolio tool, with volumes several times higher than a decade ago. Current activity appears driven more by a search for liquidity than by forced selling, as distributions from buyout funds have slowed and limited partners use secondaries to rebalance. Even so, mismatches between investor expectations and the actual liquidity profile of private vehicles can create pockets of stress and reinforce risk aversion toward less transparent assets. Overlaying this is a new category of AI-driven cyber risk. The discovery of advanced models capable of autonomously probing vulnerabilities has already triggered urgent discussions between regulators and major banks, and central banks are warning that similar threat-capable systems could emerge within a year. Combined with uncertainty around Federal Reserve leadership and a more hawkish tone on inflation, these factors increase the probability of sudden volatility spikes, even if they do not show up in day-to-day market pricing yet. To sum up, risk sentiment remains supported by strong earnings and an AI-led tech cycle, alongside structural tailwinds in commodities, defense, and real assets. But that resilience sits on top of a deepening Middle East energy shock, narrow market leadership, and growing tail risks in private credit and cybersecurity, all in a context of elevated policy uncertainty. Watching how oil supply, inflation data, earnings breadth, and volatility evolve from here will be critical for understanding whether today's fragile balance tips toward renewed risk-taking or a sharper de-risking. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.